The great melt-up continues. Fed rate cuts to fuel stocks, gold, and Bitcoin. In financial markets, the term melt-up describes a rapid rise in asset prices driven more by investor sentiment and liquidity than by improvements in fundamentals. Today, we are witnessing one of the most remarkable melt-ups in recent history. With the U.S. Federal Reserve moving aggressively to cut interest rates, capital is being unleashed across the global economy. This policy shift is creating a powerful tailwind for stocks, gold, and Bitcoin. Understanding the Fed's role. The Federal Reserve is the U.S. central bank, responsible for setting short-term interest rates and controlling the money supply. When the Fed cuts rates, borrowing becomes cheaper for banks, corporations, and consumers. Lower rates reduce the cost of credit cards, mortgages, and business loans, which tends to boost spending and investment. These cuts also push investors to seek higher returns in riskier assets, because safe instruments like treasury bonds yield less. How rate cuts push stocks. Higher equities, stocks, are often the first asset class to react positively to lower interest rates. Companies can refinance debt more cheaply and fund new projects at lower costs. Investors, meanwhile, revalue future earnings because the discount rate used in stock valuation models declines. This mathematical shift alone can increase a stock's fair value, even if profits remain steady. In addition, cheap money often sparks buybacks, mergers, and speculative trading, all of which add momentum to a rising market. This is why major indices like the S&P 500 and Nasdaq frequently surge in rate cut cycles. Gold's safe haven appeal. Gold behaves differently. It does not pay interest or dividends, but its appeal rises when real interest rates, adjusted for inflation, fall. Rate cuts tend to weaken the US dollar and push real yields lower. This makes holding gold relatively more attractive compared to cash or bonds. Historically, gold has served as a hedge against both inflation and currency debasement. In a melt-up environment where liquidity floods the system, investors often allocate more to gold as a store of value and a portfolio diversifier. Bitcoin and digital assets in the mix. Bitcoin is sometimes described as digital gold. Although more volatile, it shares some characteristics with the precious metal: limited supply, decentralized control, and appeal as an alternative asset. In the past, Bitcoin has rallied strongly during periods of aggressive monetary easing. Lower interest rates reduce the opportunity cost of holding non-yielding assets, and risk appetite spills over into the crypto space. Institutional adoption, easier on-ramps, and narratives around sound money further amplify this trend. Risks and lessons for investors. While melt-ups can generate rapid gains, they also carry risks. Excessive speculation can detach asset prices from underlying fundamentals, leading to sharp corrections. Rate cuts may initially boost asset values, but if inflation resurges or growth falters, the environment can change quickly. For investors, the key is diversification and discipline. Understanding why an asset is rising helps prevent emotional decision-making. A balanced allocation across equities, precious metals, and possibly digital assets can smooth out the volatility inherent in each category. Bottom line: the Fed's rate cuts are acting as fuel for an ongoing melt-up in stocks, gold, and Bitcoin. Lower borrowing costs, increased liquidity, and a shift in risk appetite are creating powerful upward pressure on a wide range of assets. Yet history teaches that melt-ups rarely last forever. Investors who educate themselves on the forces at play and build strategies that withstand both euphoria and downturns are best positioned to navigate this extraordinary period.